Over the last 60 days, roughly $2.58 billion moved into healthcare and life sciences venture across just 10 rounds. Today, we are walking through what those deals actually say about where capital is going in 2026 and why the pattern matters if you work in health systems, pharma, employer benefits, or digital health. First, the framing. The article we are covering argues that the market has not frozen, it has rotated. The big checks are not going to care navigation apps, AI scribes without a data moat, or employer wellness portals. They are going to companies that own something scarce, a network nobody else can replicate, a chemistry platform with licensed conjugation rights, a clinical asset at phase 2 with proof in a patient, a consumer subscription with triple-digit bookings growth. That is the thesis behind every name on this list. Point 1. Pharma is back in the cap table, and that is a signal worth reading carefully. Sanofi is in Earendil, not just as a deal partner, but as an equity investor. Regeneron put up to $200 million into TriNetX as part of a deal that gives it exclusive rights to link its genomic and proteomic data to TriNetX's roughly 300 million de-identified patient records globally. Novartis venture fund co-led Sidewinders Series B. Merck's venture arm is in Ray Therapeutics. Abbott is a strategic in Whoop. Bristol Myers Squibb seeded Beeline through Bain. When pharma corporate venture is this active alongside crossover and sovereign money, that is usually a signal that the smart money does not think this cycle is ending. It thinks specific inputs are about to become scarce and expensive, and it is buying access now. Point 2. The largest single round, Earendil Labs at $787 million, is not primarily an AI story. It is a biologics throughput story. Earendil has built an AI-native platform that has reportedly generated more than 40 biologics programs, with the lead asset being a half-life extended anti-TL1A antibody that is phase 2 ready in inflammatory bowel disease. Sanofi already signed a $2.56 billion deal with Earendil in January 2026 around bispecifics for autoimmune and IBD. Now, Sanofi is also in the equity round. The article reads that as Sanofi wants option value on 20 or more programs it cannot build internally fast enough. The underlying driver is a roughly $230 billion US patent cliff between 2025 and 2030. Pharma needs throughput, and it is buying access to AI-native foundries to get it. Point 3. Whoop at a $10.1 billion valuation and $575 million in new capital is the most interesting consumer entry on the list. CEO Will Ahmed has been clear this is the last private round before an IPO. The cap table includes Abbott and Mayo Clinic as strategic investors, which is the piece the article flags as actually meaningful. Whoop has an FDA-cleared ECG, a 65 biomarker lab panel run through Quest Diagnostics, and bookings growth of about 103% year over year. The bull case is that owning continuous physiology, quarterly blood biomarkers, and a high LTV subscription relationship with roughly 2.5 million members is a real wedge into employer programs and payer-funded prevention. The bear case is the long list of consumer health companies that collected interesting data and never solved the payment problem. Public markets are about to grade this one. Point 4. The Bain Nuco model keeps printing money, and Beeline Medicines is the latest version. Bain led a $300 million Series A for a company that emerged from stealth with 5 immunology programs in-licensed from Bristol Myers Squibb. The CEO previously took SpringWorks Therapeutics from a Pfizer spinout to 2 FDA approvals and a roughly $3.4 billion acquisition by Merck KGaA. Bain ran the same basic play with Cerevel, which sold to AbbVie for nearly $9 billion. The template is, take credible orphaned pharma assets, give them a real team and serious capital, hit clinical milestones, and sell back into the pharma arms race. With BMS, Sanofi, AbbVie, and Lilly all active in immunology, the strategic optionality on Beeline is not theoretical. What runs through all 10 of these deals is the same question. Does this company own something the next pitch deck cannot copy by Q3? Networks, chemistries, clinical stage assets, enterprise footprints, consumer engagement loops. That is the checklist. Vague workflow tooling is not on it. We covered the first 5 deals here. Part 2 of the full article and podcast goes into Sidewinder, Ray, Qualified Health, Terremoto, and Tortugas, and then synthesizes what all 10 rounds say about how the next cycle gets allocated. That part is for paid subscribers. Subscribe to On Healthcare for Part 2 and the full analysis, link below.